Human beings are hardwired for continuous action and rapid response to environmental stimuli. When we see the FTSE 100 index drop significantly, or the financial markets flash red across our television screens, our ancient survival instincts immediately kick in. We possess an overwhelming desire to do something to protect ourselves, which in the modern financial world translates to an urge to sell our positions, buy into new trends, shift our asset allocations, or attempt to hedge our bets through complex derivative strategies. But in the financial markets, this relentless desire for action is inherently expensive and often deeply destructive to long-term wealth creation. Every single time you execute a trade, you encounter significant structural friction. You are forced to pay brokerage platform fees. You inevitably lose capital on the bid and ask spread. You may incur stamp duty reserve tax if you are trading in the United Kingdom, and you consistently trigger taxable events that require you to pay capital gains tax. Over a 10 or 20-year investment horizon, these seemingly small transactional costs compound relentlessly and eat your investment returns alive, transferring your wealth to the brokers and the government. Warren Buffett combats this destructive urge for constant activity with a brilliant mental model known as the 20-slot punch card concept. Imagine you are given a physical ticket with only 20 available slots for your entire life. Every single time you make an investment decision, you must punch a hole in this card. Once you hit the maximum of 20 punches, you are absolutely never allowed to make another investment trade for the rest of your life. If you operated under these incredibly restrictive rules, you would never purchase a random equity just because of a compelling rumor or a rapid market trend. You would be forced to conduct deep, meticulous, and agonizing research before committing any capital. You would make your highly calculated choice, and then you would do absolutely nothing for decades. In the realm of equity investing, doing absolutely nothing is often the hardest, yet fundamentally the most profitable action you can possibly take. The illusion of productivity pushes us to trade, but true financial productivity requires monumental stillness. Building the psychological resilience to do absolutely nothing when everyone else in the financial world is panicking requires a profound shift in where you focus your intellectual attention. Amateur market participants stare obsessively at the ticker symbol and the violently fluctuating daily share price. Master investors completely ignore the ticker and instead stare relentlessly at the internal machinery of the business itself. True patience is never rooted in blind faith or simple optimism. It is deeply anchored in rigorous corporate financial analysis. When you sit down in absolute quiet and dissect a publicly traded company through its official financial reporting metrics, the daily chaotic noise of the stock market becomes entirely irrelevant. You are no longer looking at a geometric chart predicting price movements. You are looking directly at the fundamental reality of the enterprise. This reality is found primarily on the income statement, which acts as the ultimate truth-teller for the patient investor. You begin by tracking the top-line revenue growth over multiple fiscal years. You utilize analytical spreadsheet logic to conditionally sum specific revenue streams, observing whether this growth is driven by increasing sales volume or by genuine pricing power. A business that can raise its prices faster than the rate of inflation without losing its customer base possesses an incredibly rare economic moat. You then move systematically down the financial reporting table to evaluate the cost of goods sold. A resilient company will maintain a stable or shrinking cost of goods sold relative to its revenue, thereby defending its gross profit margin. Moving further down the income statement, the operating expenses reveal the true efficiency and discipline of the corporate management team. You analyze the selling, general, and administrative expenses alongside research and development costs to ensure management is not squandering capital on bloated corporate overhead. When you deeply understand these specific financial reporting metrics, the daily fluctuations of the stock market entirely lose their psychological grip over your mind. If you own a substantial slice of a business that consistently widens its operating profit margins, generates massive free cash flow, and delivers robust net income quarter after quarter, there is absolutely no logical or mathematical reason to sell your shares just because the broader macroeconomic environment is experiencing a temporary downturn or the market is having a highly volatile week. Understanding these exact indicators in corporate accounting tables gives you absolute, unshakable conviction. When you see that the fundamental ability of the business to generate hard cash is perfectly intact, market volatility completely stops being a terrifying threat. Instead, a falling share price transforms into a magnificent opportunity to aggressively buy more ownership in a phenomenal company at a severely discounted valuation. Price is merely what you pay to the market, but the intrinsic value is what you clearly see calculated within those reporting metrics. This calculated, highly analytical patience is the fundamental engine of compound interest. Over 90% of the immense, unprecedented wealth accumulated by Warren Buffett was generated after his 65th birthday. This is not a coincidence. It is a strict mathematical reality, dictating that the longer you leave capital entirely alone to grow, the faster and more violently it expands at the tail end of the exponential compounding curve. For an investor residing in the United Kingdom and utilizing a tax-advantaged stocks and shares individual savings account, the absolute ultimate strategy is uninterrupted time, completely exposed to the market. Consider the massive geopolitical and macroeconomic shocks of the last few decades. We have endured the devastating inflation of the 1970s, the catastrophic Black Monday crash of 1987, the massive implosion of the dot-com bubble at the turn of the millennium, the terrifying global financial crisis of 2008, and the unprecedented economic lockdowns of the recent global health pandemic. During every single one of these terrifying historical events, the financial media screamed at investors to take immediate protective action. The investors who surrendered to this fear and actively sold their portfolios permanently locked in their massive capital losses and entirely missed the subsequent, inevitable, and highly lucrative market recoveries. The investors who successfully practiced the philosophy of extreme patience simply held their equity positions tight. They continuously reinvested their dividend payments at depressed market prices, and they calmly allowed their underlying companies to continue operating, adjusting to new economic realities and generating massive operating profits based on their solid financial fundamentals. By refusing to interrupt the compounding process, they achieved staggering generational wealth. You only need to meticulously analyze the historical equity portfolio of Berkshire Hathaway to witness this philosophy operating in the real world. Warren Buffett began aggressively purchasing shares of the Coca-Cola Company in 1988. He did not buy this massive position to execute a short-term swing trade based on technical chart patterns. He bought it because the annual financial reports clearly revealed an unshakable global consumer brand with incredibly durable gross margins clearly visible on their income statement. Furthermore, the company required very little retained capital to grow its physical operations, meaning it could distribute massive amounts of free cash back to its owners. For over 30 consecutive years, his primary action regarding his Coca-Cola investment has been sitting entirely still in his office. Today, the massive annual cash dividends that Berkshire Hathaway receives from Coca-Cola are equivalent to substantially more than half of his entire original investment principal. He receives his entire initial purchase price back in pure cash dividends every 2 years, simply because he possessed the discipline to do absolutely nothing. The exact same powerful dynamic applies to his massive investment in Apple. When he began acquiring shares of the technology giant in 2016, many highly active Wall Street traders confidently declared that the hyper-growth phase of the business was permanently over, and that he was entirely too late to the party. But Warren Buffett completely ignored the media noise, looked directly at the underlying financial statements, and saw a remarkably sticky consumer hardware and software ecosystem generating truly staggering amounts of operating cash flow. He recognized that the high switching costs for consumers created a permanent economic moat. He held this massive position through severe periods of intense technology sector volatility, deliberately ignoring the overwhelming urge to trim his position or take profits after a temporary 10 or 20% bump in the share price. He allowed his massive winner to run uninterrupted, actively benefiting as the management team used their massive free cash flow to buy back their own shares, thereby increasing his ownership percentage without him having to spend another single penny. This absolute patience turned into many tens of billions of dollars in pure, unrealized profit. The fundamental truth is that to make truly life-changing big money in the equity markets, your investment portfolio needs to be incredibly boring. Excitement is the absolute enemy of compound interest. You must do all the difficult, rigorous analytical homework up front. You must learn to deeply understand the income statement, the balance sheet, and the cash flow statement. You must comprehend the complex relationship between capital allocation, return on invested capital, and the weighted average cost of capital. And then, once you have identified a truly magnificent enterprise trading at a reasonable valuation, you must master your own human psychology by doing absolutely nothing for years or even decades at a time. You must train your brain to fundamentally detach the performance of the underlying business from the highly erratic daily voting machine of the stock market. Modern financial infrastructure is deliberately designed to destroy this necessary patience. We are currently surrounded by 24-hour financial news networks that require constant dramatic narratives to maintain viewer ratings. We are targeted by sophisticated smartphone trading applications that utilize addictive gamification techniques, flashing lights, and push notifications to simulate the physiological environment of a casino. We are bombarded by social media influencers promising rapid wealth through highly leveraged day trading strategies, options trading, and obscure cryptocurrency speculation. All of these external forces are highly optimized to trigger our inherent biological bias toward immediate action and instant gratification. They want you to trade because your constant trading activity is exactly how the financial industry generates its massive systemic profits. Wall Street fundamentally makes its money on your frenetic activity, but you will only make your money on your absolute inactivity. To combat this incredibly toxic environment, you must actively cultivate a philosophy of financial stoicism. You must learn to view the stock market not as a hyperactive casino where you place directional bets on price movements, but merely as a passive underlying mechanism that occasionally offers you the opportunity to buy fractional ownership in real, cash-producing businesses. Ben Graham, the original mentor of Warren Buffett, famously created the brilliant allegory of Mr. Market. Imagine that you are partners in a private business with a highly manic, depressive individual named Mr. Market. Every single day, Mr. Market knocks on your door and offers either to buy your half of the business or sell you his half of the business at a specific price. Because Mr. Market is emotionally unstable, the prices he quotes you are often entirely irrational. Some days he is wildly euphoric, and quotes a ridiculously high price. Other days, he is deeply depressed and quotes a terrifyingly low price. The truly fatal mistake that most amateur investors make is allowing the daily emotional state of Mr. Market to dictate their own perception of the underlying value of the business. When Mr. Market is depressed and quoting low prices, amateurs panic and sell their shares to him at a massive loss. The patient investor, armed with a deep understanding of the corporate income statement and the actual cash flows of the business, completely ignores the daily emotional outbursts of Mr. Market. The patient investor only interacts with Mr. Market when the quoted price represents a massive, undeniable fundamental bargain. On all other days, the patient investor simply ignores the knocking at the door, stays inside, reads the annual reports, and allows the underlying business to continue generating internal value. This level of profound emotional detachment is incredibly difficult to achieve because it requires you to actively suppress your natural human instincts. It requires you to look extremely foolish for long periods of time. During the massive technology bubble of the late 1990s, Warren Buffett was widely mocked by the mainstream financial press for refusing to buy into unproven internet companies that possessed no actual revenue or net income. He patiently held on to his boring, cash-producing traditional businesses while technology stocks soared to astronomical valuations. The media confidently declared that he had lost his touch and that his value investing philosophy was permanently obsolete in the new digital economy. But he refused to compromise his strict financial reporting standards. He refused to pay exorbitant prices for businesses that lacked a fundamental economic moat or a clear path to generating sustained free cash flow. When the technology bubble inevitably burst, completely wiping out trillions of dollars of speculative retail capital, his boring portfolio of resilient businesses continued to generate massive profits, permanently cementing his legacy as the greatest capital allocator in modern history. The exact same dynamic constantly plays out in the modern financial markets. There will always be a massive, highly publicized, speculative bubble occurring somewhere in the global economy. There will always be a new, incredibly complex financial instrument promising rapid returns without any corresponding fundamental risk. There will always be a charismatic corporate executive promising to completely revolutionize a massive global industry, despite their company burning through billions of dollars of shareholder capital with no clear path to achieving actual operating profitability. The patient investor completely ignores all of these massive distractions. The patient investor ruthlessly demands to see the fundamental mathematical proof located entirely within the audited corporate income statement. The patient investor strictly requires a demonstrably high return on invested capital, a massive runway for future reinvestment, and a fiercely highly competent corporate management team that treats shareholder capital with the utmost respect and fiduciary duty. Once these incredibly strict criteria are successfully met, and the initial capital allocation is finally made, the true psychological test begins. You must be entirely prepared to watch the market value of your portfolio temporarily decline by 20, 30, or even 50% without experiencing the slightest urge to sell your positions. You must deeply internalize the fundamental difference between temporary market volatility and the permanent loss of human capital. Volatility is simply the natural, unavoidable price of admission required to achieve long-term compound interest. It is the fundamental risk premium that the market demands in exchange for delivering long-term wealth creation. Permanent loss of capital, however, only occurs when you permanently interrupt the compounding process by panic selling during a massive market drawdown, or when you mistakenly invest heavily in fundamentally flawed businesses that eventually go bankrupt because their core business model was inherently unprofitable. By anchoring your entire investment philosophy strictly to the objective reality of the corporate income statement and the audited financial reporting metrics, you entirely eliminate the massive risk of investing in fundamentally flawed businesses. And by actively cultivating a deep, stoic patience, you entirely eliminate the massive risk of panic selling during periods of extreme market volatility. You transform yourself from a highly emotional, highly reactive market speculator into a deeply rational, incredibly patient business owner. You stop renting random ticker symbols and you start permanently owning phenomenal corporate enterprises. You completely stop trying to predict the highly chaotic macroeconomic future, and you start relying entirely on the fundamental mathematical certainty of long-term compound interest. This extremely patient methodology is certainly not glamorous. It will completely fail to provide you with thrilling stories to tell your friends at social gatherings. It will not give you the immediate dopamine rush associated with executing a massive, highly leveraged speculative trade. But it is the absolutely proven, mathematically certain pathway to building truly massive generational wealth over the course of a human lifetime. The stock market is fundamentally designed to be a highly efficient mechanism for transferring massive amounts of capital from the extremely hyperactive and deeply impatient market participants directly into the pockets of the intensely analytical and rigorously patient long-term investors. Your ultimate financial success or failure will not be determined by your fundamental ability to predict short-term market movements, but entirely by your inherent psychological ability to conquer your own fundamental human nature. Do the deep analytical work required to understand the financial reporting, acquire magnificent businesses at reasonable valuations, and then spend the absolute remainder of your natural life practicing the incredibly lucrative art of doing absolutely nothing.